wanted to focus on hotels as an asset class, as it is a sector that continues to be quite attractive in the private capital space. What we'd like to explore here today is what we're seeing specifically in this sector and what we're seeing in the hospitality space.
2024 was a real return to form for hotels as an asset class. 2023 was quite challenged in terms of transaction volumes, but 24 saw £5.75 billion worth of hotels transact in the UK, something like €22 billion worth of hotels transact in Europe.
In real estate, what everyone would appear to want is big assets, and we actively look at the exact opposite of that. I want to buy things people don't want to own and turn them into things people might want to own.
Hospitality is booming. My side, I haven't seen as much transactional activity because it's very expensive to buy any decent hotel. If it's doing well, and they all have been doing very well post-COVID, people don't sell at a reasonable price.
Is the demand there, would you say? Because I think
demand is huge.
Yeah.
So put it this way, all of my families have said to me, do you have any hotels? Do you have any other clients who want to sell their hotels? Do you have any hotels doing badly? If a hotel's doing badly, there's something very wrong with it.
The beauty of the hotel asset class is it offers you everything from roll your sleeves up and get involved in the day-to-day right through to fixed income, hands off. It's a completely passive investment.
Wealthy people like hotels. A lot of them like to own the shiny asset themselves because they like to spend time there and bring their friends there and all that good stuff. Or they've inherited it from their family and they want to keep it. So I think it's a fascinating sector.
There are two things I worry about. One is, am I overpaying? And the other is, am I backing the right people?
It's still very unclear what role sustainability is going to play in the sector.
What sort of problem areas come up and that could potentially will even kill a deal?
The big one at the moment, and there's no getting away from it, every transaction is CapEx.
It's a big problem for even the smartest people with the right vendor due diligence, with the right consultants.
We're now having a session on focusing on a particular asset class. This is a session on Spotlight on hotels as an asset class, looking at strategic investment and trends in the private capital space. I'd like to welcome the panel for this afternoon. We've got Tom Bosco, who's the Deputy Managing Partner of Alchemy Special Opportunities. Alchemy specialises in investing in debt and equity special situations across Europe. Tom is a deputy managing partner at Alchemy, where he's been since 2008. He works across debt, equity and restructuring investments and leads the firm's activity in hospitality and real estate, as well as covering other sectors from time to time. Prior to Alchemy, Tom was responsible for M&A at TSYS, and before that was strategy consultant with LEK. Tom has a degree in natural sciences from University of Cambridge and lives in Fulham with a noisy house due to 3 small boys. Thank you, Tom. We've got James Greenslade from Savills, who's Director of Hotel Capital Markets. James is focused on the disposal of independent, branded and franchise hotels across the UK's regions, both on a single asset and portfolio basis. He has 13 years of experience in hotel brokerage across the UK, being involved in or executing over £1 billion of hotels transactions. And finally, we have Sadam Salaheddin, who's the Global Head of Real Estate in Deutsche Bank on the private bank. Since 2018, Sadam has been responsible for the global real estate lending within Deutsche's private bank. Prior to that, he spent some 20 years mainly in investment banking, working for Morgan Stanley and Credit Suisse. Much of that was focused on real estate and related areas, including hospitality, travel and leisure. Sadam is also a qualified solicitor and has spent a number of years as an independent advisor to and board member of some of Europe's largest development and construction businesses, both private and publicly listed. Thank you all for being here. I'm Murray Bates. I'm a partner in the corporate team at Farrow & Co. We are a full-service law firm, as I'm sure some of you heard earlier. Our corporate practice focuses on private capital transactions, and I have a particular focus on corporate real estate, which is why we're here talking about hotels. So welcome, everybody. We wanted to focus on hotels as an asset class, as it is a sector that continues to be quite attractive in the private capital space. We've been hearing across the course of today about the sort of broader private capital landscape. I think it's fair to say that we've been in a relatively challenging period for investing, notwithstanding the amount of capital there is available to deploy and the pressure on funds to do so. I mean, we've been finding, certainly on the corporate side, that the M&A activity has still been relatively flat. But what we'd like to explore here today is what we're seeing specifically in this sector and what we're seeing in the hospitality space. I'm sure each of you will have your own insights into this, but I mean, maybe we could start with you, James. What are you seeing? Is the sector still quite active? What does deal flow look like?
Thanks, Marie. So I think 2024 was a real return to form for hotels as an asset class. 2023 was quite challenged in terms of transaction volumes, but 24 saw £5.75 billion worth of hotels transact in the UK, something like 22 billion euros worth of hotels transact in Europe. For the UK, that was 20% up on the 10-year average, so clearly performing well in context of that historical performance. And in Europe, that's a 5-year high. I think the nuance is clearly in what is driving that activity, and it came down specifically to portfolio transactions and private equity. So private equity was really what drove that transaction activity, both across the UK and Europe last year, and predominantly American private equity. So of that 5.75 billion in the UK, around 2.7 billion was US PE, which accounted for 97% of overall transactions. The component that was attributed to that PE element was something like 500% up on that long-term 10-year average. So that gives you a sense of the market being somewhat unbalanced in terms of that investor pool. The same is true of Europe. I think of that 22 billion, about 25% was attributable either to Blackstone, Starwood, Oaktree, KKR or Baupost. And by virtue of that PE component, a lot of the activity was portfolio. So again, portfolio transactions, something like 60% up on that long-term average. I think that is a good indicator of liquidity coming back into the market and is giving us confidence that 2025 will be another good year. I think we're expecting it to be lower in terms of total volume, but actually probably higher in terms of number of assets transacting. And I think what that means for us in terms of sort of trends to watch out for this year is a larger number of single asset transactions, a much more balanced investor pool looking at hotels as an asset class, and probably that improving debt liquidity picture driving that more balanced investor pool, which is going to drive transactional activity in 2025.
Yeah, interesting. And Tom, would you say that sort of reflects your experience as well, looking at it from the private equity angle?
Yeah, I mean, I think we've had a super busy year in the hotel space.
Yeah.
We're currently actively buying assets in 6 separate hotel platforms across 5 countries. And in this capacity, I'm kind of talking as a real estate private equity investor.
Yeah.
But we're not the typical investor, so it is worth clarifying kind of what we do. So,
Yeah.
as it says up there, Alchemy Special Opportunities. The idea that our basic thesis, we're value investors. Our idea is that there are great investment opportunities across a whole range of different things, debt, equity, different sectors that are overlooked by mainstream investors because they are too granular, too complex, don't fit in a bucket that they've marketed to their LPs. And so we try to look for things other people don't want, sort of by definition. And in real estate, what everyone would appear to want is big assets that they can invest into in scale, that are well invested, well located, relatively simple to operate. And we actively look for the exact opposite of that. So we're kind of counter trend in that regard. Our typical type of investing will be, what's interesting is what the mainstream is looking for. You can find a certain amount of, but Europe is fundamentally fragmented. So I think my favorite stat is Italy has 36,000 hotels owned by 35,000 different people. So if you're looking for well invested groups of assets, you're not going to find them in Italy, but you are going to find lots of individual assets. And that's the sort of thing we invest into. So we set up teams or back very small platforms. initially, sometimes often 5 or 10 million of our money, but try to scale those by taking full control of them, running them like a private equity business, but using that opco to go and buy individual real estate assets. So we will, we had a group in the north of the UK, we built a group of 31 assets with 26 separate transactions. So that for us has been super active this year, and is underpinned by the dynamic that there's just a lot of stock out there owned by people who are aging and whose kids don't want it. And there's very little institutional interest in buying small problematic assets, but there's a lot of institutional interest in buying the big stuff that's been polished, like lead to gold alchemy. That's kind of the idea. We have been very active, but I wouldn't say that's necessarily typical.
Yeah, interesting. And then I guess, Sadam, you probably see a sort of broader bit of the market as well from a lending perspective. Again, have you find that the current market activity is as busy as we've been hearing?
Yeah, my side is a bit different. I would say, so as a private bank, we bank everybody from one of those 35,000 Italian individuals or families that has one hotel. So I have guys with a 20 million hotel in Palma de Mallorca or a 14 million hotel in Florence. They've had for 100 years in the family, right up to a $1 billion plus loan to a royal family from the Middle East that has, 10 billion of hotels. And some are very institutional, some are absolutely non-institutional. That's what makes it quite fun. So you're dealing with all different shapes and sizes. So the activity that I see is I'm not transactional driven like my two colleagues here on the panel with me, because we can refinance things that people already own. So I'm refinancing things that people own. I'm helping them redevelop things that need to find a new life, because we all know as consumers of hospitality how quickly the sector's changing, and we'll talk more about that later, but there are new forms of hospitality coming up every day. Our tastes as consumers keep evolving and keep changing, and more types of hospitality are needed in more locations. So look, naturally our clients are putting money into that and developing that stuff, and we help support that journey. The big guys on the big shiny side are continuing to roll out big hotels. I have 3 in Venice. I think there are 3 ultra 5-star hotels either coming back to market after hundreds of millions of renovation or coming to the market for the first time in Venice in the next year. I just don't know how it works, and yet the Cipriani is managing to get 2,800 euros per night ADR. Somehow it works. The money is coming from somewhere. People are spending on hospitality. Hospitality is booming. My side, I haven't seen as much transactional activity because it's very expensive to buy any decent hotel. If it's doing well, and they all have been doing very well post-COVID, people don't sell at a reasonable price. They'll sell if somebody comes in and offers them something silly. So if you want to buy, you have to really roll up your sleeves, as Tom said, reposition things, grow things, find something that's exploiting a new niche and support them to grow into that space. And we see that. But transactions of actual big hotels between the moneyed families, don't see very much of it at the moment.
And is the demand there, would you say? Because I think
demand is huge.
Yeah.
So put it this way, all of my families have said to me, do you have any hotels? Do you have any other clients who want to sell their hotels? Do you have any hotels doing badly? If a hotel's doing badly, there's something very wrong with it, because almost all hotels, any half-decent hotel, has done very well in the last few years compared to 2 or 3 years ago. So if it's not doing well, it's either in the wrong place, it's very badly managed, or it just needs a lot of capex to turn it into what people want to spend it on today. And if you're Tom and you have that capital available to turn it around, and you have the management that you can come in and change things, then obviously there are opportunities. Some of our clients want those things too.
Yeah.
But I would say it's a difficult market to find easy opportunities to buy hotels at a good price.
And I mean, I think the FT described it as the sort of white lotus effect, that absolutely, the families are looking for these assets. But I mean, maybe that's nothing new, is it? Or
nothing new. The wealth. I mean, let me just give you one quick anecdote. I came to Deutsche 7 years ago. At my previous shop, I did hotels. We didn't really have. There was a couple of small hotels with very long relationships. We had no hotels. Fast forward to today, it's 1/3 of my book globally. It's my largest single asset class. I have 38 hotels on the book ranging from LA to Hong Kong, and a pipeline of more coming. So wealthy people like hotels. Some of them go in direct through people like Tom, quite rightly. A lot of them like to own the shiny asset themselves because they like to spend time there and bring their friends there and all that good stuff. Or they've inherited it from their family and they want to keep it. So I think it's a fascinating sector. It is very, very strong. There's lots of different aspects to it, and different, every country and every type of hotel that's developing is quite different. But we're very busy in the sector, even if I don't see a lot of transactions.
And I guess it might be helpful then, just moving on from a few things you touched on just now, to think about the different ways investors might structure their sort of investment into hotels. And we sort of talked about going in directly or through funds. And James, what are you seeing if you have a client coming to you saying, I want to invest in hotels?
I think the beauty of the hotel asset class is it offers you everything from roll your sleeves up and get involved in the day-to-day right through to fixed income, hands off. It's a completely passive investment. Generally speaking, if it's not owner operated, it's generally on that sliding scale towards divorced from the day-to-day. So there are third-party white label operators you can bring in to look after the management side of things for you, and you can cherry pick different bits of their business to assist you on the way through. You can then layer in brands and franchise agreements from brands, or even direct brand management to deliver the specific asset that you want. And each of those opportunities or decisions is going to be different for different investors, different assets in different locations. I think one of the questions that we're seeing owners ask probably more is, previously a brand was almost a foregone conclusion in some scenarios, and now it's a question of, does brand bring value when you've got B2C access through third-party OTAs, online travel agents? It begs the question around the strength of a brand's distribution system and whether the cost of plugging into that and paying the fees is actually reflected in the output. And there's no right answer. For some locations, the location alone will sell the rooms. For other locations, you may need that brand reach to bring in overseas business or conference business or whatever it may be. I do think that it's worth considering not just the operational side of things as well, but also depending on an investor's view to exit, it's worth looking at the potential yield compression that those structures can have on exit in terms of a well-structured franchise agreement with a good brand, flexibility of management with a good white label operator, which from an agency and a brokerage perspective gives you more opportunity to look at flexibility in different ways that you do things. But that's a long way of saying there isn't necessarily one specific route. There is opportunity to flex and create the best situation that suits specific requirements.
Suits the investor, fundamentally. So I guess if an investor wants to come in and has the confidence and experience to run it themselves, then they can acquire the asset and get the right people in and bring them in. And then I guess the sort of other end of the spectrum is, they want to own the land, but get someone else to run it, and that could be a franchise agreement from quite a well-known brand, or
correct. And everything in between.
And everything in between, absolutely. And maybe if we could just do then a bit of a deeper dive into that sort of investment and the transactional side of things. And I'm a lawyer, I come at these things from sort of risk perspective, but what are the problem areas? Tom, you do a whole load of transactions, and you talk about how you guys do roll your sleeves up and get involved, and what do you find are the sort of real problem areas that come up in deals?
Well, I'm not going to give you anything very technical. There are two things I worry about. One is, am I overpaying? And the other is, am I backing the right people? If I think about overpayment, clearly it's a kind of generic point, but if you overpay for something, it doesn't matter how clever you are owning it, you've got a problem. So we certainly steer away from anything that's competitive. And I've bought 130 something hotels in the last 8 years. And I think maybe on one hand, I can count the number that were competitive. So we're buying stuff totally off market. Now, that doesn't mean you're paying a fair price, but it's a good start. We steer away from luxury because I think shiny assets are the sort of assets people want to own. I want to buy things people don't want to own and turn them into things people might want to own. I think for me, because we're often starting off with little platforms and then bolting lots in, the way overpaying manifests itself is we know we're paying up for the initial platform, and that can act as quite an anchor on our overall valuation. We need to buy lots of stuff cheaply to drag the valuation down. So our diligence really is focused on, do we think there's enough depth of good stuff or bad stuff in the market to buy that we can average our price down? So that's one of the key things for us. Ultimately, will we own this platform at 6 times EBITDA that we think is worth 11? And then secondly is the team. What we do is, well, what the management do is complex. I certainly couldn't do it. We're backing them to do a lot of hard work to grow something massively over a short period of time. And they've got to be capable. I asked myself 2 questions. Are they capable of doing that? And actually, do I like them? Do I enjoy spending time with them? Because I have to spend a lot of time with them. And if you get on with someone and things are going well, you'll make more of it. If something's going badly and you get on with them, you'll fix it. So I think there's a very big correlation between the quality of management teams, and again, that sounds a bit generic, but even in something real estatey, and the outcome. And the way we diligence that is the reason I'd never buy anything in a process. Sorry, James. In processes for buying businesses, you might get 2 hours with management in some kind of heavily orchestrated meeting, and then you might get to speak to them for another 2 hours. We've just bought a business in Scotland. I must have spent 150 hours with the chief executive over the course of a year. So I've got a pretty good view that I'd like him when we get on, and to me that's fundamental.
Yeah, interesting. James, when you're sort of brokering the deals, I mean, what sort of problem areas come up and that could potentially sort of, even kill a deal?
The big one at the moment, and there's no getting away from it, every transaction is CapEx. And a lot of that is around cash availability over the last few years. Defensive CapEx is very different from that offensive opportunity. So that latent CapEx liability is something on the way in when we're looking for deal risk that we're looking to try and address. It's not simply enough to do a vendor due diligence TDD survey. You need to address some of those items. You need to have a plan and to cost it, because a buyer is going to effectively be taking a view on that in respect of price. So the more that you can have a handle on the liability that exists in terms of the assets, that's where the key risk is for us at the moment.
Yeah, interesting. And Sadam, you're sort of further down the track sometimes. You wouldn't necessarily just be at the beginning of a transaction. As you said, it would be, they might already own an asset and you'd be looking at refinancing. But what issues do you see come up with the asset class that does really need you to get involved and try and resolve the investment?
I'd agree with the CapEx. I mean, I have a client who has 150 hotels around the world. They really know what they're doing. They were already managing a hotel and they took over the ownership a year and a half ago, and I financed that acquisition. They found, as they started to try and refurb room by room, that none of it was fire compliant for the Italian authorities, have to rip out everything, start again. So it's a big problem for even the smartest people with the right vendor due diligence, with the right consultants. You don't always know what's behind the walls and how things have been built, the older stuff, which is historic, obviously. So I think that is a big issue. I think that's the main one.
I mean, I guess sometimes, when we come at it from a sort of the legal perspective, I guess another area, it is very much looking at what are their processes and the data. Is their data clean? I mean, that is quite an old case now, but of course, when Marriott acquired the Starwood Group, they got slapped with quite a big fine from the ICO, not because of their initial lack of data compliance, but not then fixing it later. So I guess there's the sort of hotels piece and then the operational piece, and when you're...
I think one interesting thing I would add to that is it's still very unclear what role sustainability is going to play in the sector. I do all real estate. So I do all real estate, as I said, from LA to Hong Kong, 15 countries, growing to 18 this year, all different real estate types. Hotels happens to be a big sector for us. But what I see is that the other sectors are becoming increasingly regulated. We all know the office story. Office is very, very weird in the UK at the moment. It's at a world record high for rentals if it's green, and if it's the opposite if it's not green. And it's not the right type of office that people want to have today. I don't know about the other guys, but sustainability is creeping into the hospitality industry. Obviously, we all want to see it, but are people really paying for it? If you look at Booking.com, the amount of people's choices that when they tick, what they're looking for, that actually put sustainability is, I think, 3 or 4%. And I'm not sure people will pay more. They might start preferring that, and they might have a penchant for it, except if you're at the very high luxury end of the market. I think at the very high luxury end, there are people clearly who want that. People are starting to move into eco resorts and more types of things related to wellness where sustainability is more important. But it's such a competitive industry. You're fighting for every penny of margin. I don't think yet the consumer, you ask yourselves, are you paying extra to stay at the Hilton rather than Mandarin, or the Mandarin rather than the Rosewood because of the sustainability of that property? Probably not, I don't know. But it is coming in, and our clients are asking about it because they know that it will, at some point down the road, it will happen. It probably has to be pushed by regulation. There has to be some sort of EPC minimum that you have to hit. And I don't know how they're going to do that in our industry, because a lot of these listed buildings and old properties in the countryside are not ever going to be, BREEAM excellent or EPCA, that's for sure. So difficult question to grapple with.
But, and that's a really interesting point. I mean, are you looking into this when you're doing your diligence? I mean,
we don't do any high-end luxury stuff, and I think at the moment sustainability is a luxury that you can add on if you want. I think we do it if it makes financial sense, and I deal with it with the same kind of level of skepticism I look at every other sort of decision. I mean, we have a chief exec in a German hotel group whose answer to sustainability is to hide the second towel at the top of the cupboard so you don't use it. Now, maybe that's not quite where the industry should go, but it's a financial thing.
Yeah. And I mean, when buyers are coming to you, do they ask about it?
It's not top of the priority list. I mean, we're starting to see a little bit more lender requirement to see visibility on where it sits in terms of minimum threshold and route to best practice. But to the points made, it's about, for a lot of people, the operational returns, and that's a greater degree of focus.
It will start to have an impact on all the industry, though, because I talk to the regulator. I have to report to the ECB. The ECB grills us on what proportion of our loans to real estate are green, and why are not more, and why are we doing another office loan to a brown office rather than whatever else we're doing. They don't yet dig down into hospitality per se, but those numbers are being tracked, and management is starting to track them and be rewarded by those numbers. So eventually we will have to differentiate the cost of capital to non-sustainable assets. And if that's our largest asset segment, it will hit hotels at some point.
I was going to say, I suspect sustainability has taken a slight backseat given the massive wage inflation a lot of hotels are dealing with, particularly in the mid-segment. I mean, as I say, we have hotels in Germany. I think the average cost of an employee has gone up 32% or something in the last, I can't remember, it was 2 or 3 years, and rates haven't gone up. So they're fighting a fire on that. As soon as that eases, then they can build a bit more margin and think about those trade-offs.
Agreed, yeah.
Yeah, I mean, the people piece isn't something that's really sort of come up until now, but again, I guess in this challenging market, I guess those are the priorities, aren't they? There's sort of NI, and can you get the right people, and is that something that, I mean, I guess it's something we saw in the news a lot quite soon after Brexit, but does that continue to be a challenge for hotels?
I mean, definitely. I mean, it varies, I guess, exactly where you are. So we've got everything from very limited service hotels where it's a bit better, but then you're expecting high margins anyway, to big pub food hotels that do 600 covers on a Sunday lunch, and that is a very staff-intensive model. So it's a real squeeze.
Yeah.
The hope is that over time that sort of normalises, but every year getting hit with 5 to 15% wage inflation is a problem.
Yeah, absolutely.
Our research team did a piece of analysis around just in isolation the impact to hotel profitability of wage increases. So that's hotel wage increases and NI contributions, so not allowing for supply chain inflation as well, not allowing specifically for any F&B. And the outcome of that was across the board, it's something like 2.3% straight off bottom line as a percentage of total revenue, which is when you're faced with increasing utility costs, increasing food and procurement costs, potentially rates revaluations next year, there are a lot of those operational headwinds that are probably ahead of ESG as a concern.
Yeah. I mean, you can get a sense that there's a lot going on at the moment, which makes it a very competitive and challenging environment. And yet, it's great to see that it is still considered to be an attractive asset class.
Well, I was going to say there's a silver lining to that too, with the obviously special opportunities in the name.
Yeah.
To the extent a bit of stress goes through an industry, it's quite good if you want to go and buy stuff, particularly if you want to buy the smaller, more fragile businesses, because they get hit harder. So if you've got a very big profitable unit, it's a bit of a stress, but it's not terrible. If you've got something that is, run by the owner operator is in his 70s, the asset is 70 years old, built in the 70s, needs capex, that sort of stuff comes up to the market. And as long as you're continuing to buy as an investor through that period of stress, you sort of average that out. So it's been we had one hotel group in the Lake District. We bought 19 sites in 19 separate transactions during COVID itself.
Great. Yeah, interesting. And I mean, we've sort of dipped into particular sort of trends that we're seeing at the moment, but I guess for the last sort of 5 minutes or so, it'd be really interesting to see what trends we see coming up, sort of horizon scanning. Are there any sort of new emerging trends that, Sadie, if I can start with you, what have you been seeing?
I'd say the proliferation of different types of hospitality and more speciality types. So 10 years ago, you didn't really see pod hotels. You didn't see a lot of real wellness hotels. You had Lanzerhof, Murano, you had a few others, but one in, SHA in Spain, something in Arizona. And now that whole wellness, people have realized, number one, we all want longevity, we all want wellness. People are ready to spend more on that. But more importantly, you could go to the mountains, buy something which is open 5 months of the year and turn it into something that's open 12 months of the year. Obviously, a game changer for the value of that hotel. And the same concept applies for anything else that you do. If you can turn it into a destination and lengthen the season or lengthen the day from the morning to the night, it's a game changer. And I've seen there are more F&B focused hotels, things like La Réserve or Nolinsky Brach in Paris and in Italy, where because the restaurants are so good, you don't go out of the restaurant in your hotel, and people in the city all want to come to your restaurant. Yeah. Therefore, they can charge $1,000 a night for the 20, 30, 40 rooms that are there. I mean, those have an enormous EBITDA margin. The 5 Hotel in Dubai, one of the highest EBITDA margins I see, because everybody drops $1,000 to $2,000 a night on their party, room by the pool, table by the pool, magnums of Whispering Angel, all day and night long. It's a 24/7 party, So there's more and more focus on, you go to a hotel because you're looking for the boutique, very cool F&B. You're looking for the spa, the wellness. You're looking for the family experience. You're looking for the hunting lodge, retreat, golf, nice whiskies in Scotland. Whatever they may be, there's a proliferation of the pod hotel because you only want a small room because you're visiting the city. There's just more and more types of hotel springing up, more brands, and even the big brands. If you look at a Marriott probably has 30 brands or 40 brands today. Intercon the same, and they're all mushrooming because each brand is tailored for a different taste. So look, it's fascinating. It's changing very, very quickly. It's different in every country, but that's what makes it interesting for me.
Yeah, great. James, what's the horizon view?
More of the same, really. I think just focusing on those margin pressures that we were talking about, it's sort of the hotel adjacent asset classes, extended stay and hostels, which are really offering the opportunity to protect margin with that lower cost base. So Brookfield acquiring Generator, you've just seen Tristan acquire Easy off the back of previously acquiring Point A. So the movement of private equity that previously would have been looking at pure hotels as an asset class, now looking at hostels and these other types of operations. I think we'll see more of that. I think there's more to come in that space.
Yeah, I was chatting to one of our colleagues who really looks at this space and other sort of type that they mentioned was sort of branded residences as well. That's again another sort of new offshoot of sort of types of hospitality, and we're seeing. Tom, any other sort of trends you're seeing?
Yeah, I think the trend that really interests me is consolidation. Yeah. So if I go back to my 35,000 owners of hotels in Italy, the average profile of those people is they're in their mid-70s. And in 10 years, they'll be in their mid-80s. And, well, we all know what happens after that. And their kids have a choice, which is they can have a few million quid for the hotel, or they can go and borrow 5, 6, 7 million quid, reinvest in the hotel and run dad's business for the next 20 years. And I think that choice for most people is pretty obvious. So I think you're talking a different piece of the market from certainly way away from the luxury end, but that very fragmented base of owners. Some of those assets will drop out of being hotels, but I think a lot have to consolidate. And at the moment there is, because it's granular, because it's difficult, because they're difficult people to deal with, there is very little capital addressing that.
Yeah, interesting. One other sort of trend I wanted to touch on, when we were sort of prepping for this session, we talked about the role of tech, and there was a session on deep tech earlier today, and we were sort of wondering whether AI, is going to play a part. I know there were some views on this, and James, what are your thoughts on this?
I think I don't assume to be an expert on AI. I think from talking to clients and understanding where they see the application for their businesses, it's about being leaner, and it's about understanding the data. There's a lot of data that you capture around a hotel guest. A lot of that is not used.
Yeah.
So I think it's the opportunity to be more nimble with how you staff businesses, how you procure for your guests, by understanding that flow of guests in your business better and their needs and requirements. So it's not necessarily something that as a consumer you're going to see that AI application when you're there, but it's an opportunity for owners and operators to potentially find economies and efficiencies.
Yeah, so optimising using your data. And is that something you're doing at the moment, Tom?
Well, I was introduced to ChatGPT by my 9-year-old a couple of weeks ago, so I'm probably not the right person to ask. But I'm sure it will have. I can imagine it having quite a big impact in yield management. I mean, if you can just optimise yield by £5 in the peak or £5 in the shoulder across the year, it just all drops straight to the bottom line. And that's evolved massively over the last 10 years from somebody plugging in prices. I remember we used to have a business called Park Deal, which is a caravan park business, and this was only 10 years ago. It was the biggest one in the UK. We used to publish the prices in November. They were in a book, and then the more nervous we got, the more we discounted them, which is obviously the opposite of yield management. Yeah. And I mean, that was only 10, 15 years ago. You've now got much more sophisticated yield management, automated yield management, and I'm sure it's out there already, AI yield management.
Yeah. Is that something that comes across your desk?
Yeah, I would say in a slightly different way. I see people like LVMH going aggressively into luxury hotels, more and more so. And my first thought was, they want to use it as a retail store. So they will use Moet Hennessy drinks in the bar. They'll put their linen, they'll put their furniture, et cetera, et cetera. They have enough products to sort of fill the hotel with all their different bits and pieces. But I think the AI aspect is the data on the customers, because if you have customers living surrounded by your products, you see how they use them, what they like, what they don't like. You have profiles on them because they probably have loyalty programs with several of you know where they live, what they buy, how often they buy, what they spend on. And that's power. We've seen that used in all sorts of businesses that I'm involved with outside of hospitality, from Harrods to whoever, and how they can become very powerful with that data. And I think the big houses are, especially if they're multi-brand, see hospitality as a great way to have 24/7 live data on what people are doing and where they spend their time and their money. And that tells them what they should be, how they should be marketing to these people.
So interestingly, maybe we could almost change the asset class to these are data companies as well in some respects. And
I think luxury is knowing what people, not what the trends are, where people are spending their money and what they want in the future, where they're heading, because then they'll adapt what they buy next to add into their portfolio, or how they develop the next collection of whatever product they make.
Yeah.
So it's quite fascinating. Yeah.